Welcome to ACCA Performance Management Chapter 12, Advanced Variances. In this session, we will explore how to understand, calculate, and interpret advanced variances including planning and operational, mix and yield, sales mix and quantity, and fixed overheads. By the end of this lesson, you will be able to explain every major variance type, apply the formulas correctly, and understand how they affect business performance and exam success. Let's recap basic variances. This table summarizes key variances. Sales price variance equals actual price minus standard price times actual quantity. Volume variance equals actual quantity minus budgeted quantity times standard price caused by market demand or pricing. Material price and usage variances show cost or wastage differences. Labor rate and efficiency variances reflect pay rates, productivity, and idle time. Material usage variance can be split into two parts: mix variance and yield variance. Mix variance measures the impact of using a different proportion of materials than planned, while yield variance measures the efficiency of turning input into output. Together, they explain whether inefficiency came from the wrong combination of materials or from the production process itself. The formulas are simple. Total usage variance equals mix variance plus yield variance. Mix variance equals revised standard mix minus actual mix times standard price. Yield variance equals actual input minus standard input for actual output times average standard price. For example, the standard mix is 60 kilograms of material A at $2 and 40 kilograms of material B at $3. Actual usage is 50 kilograms each with 95 kilograms of output. Mix variance equals $20 adverse. Yield variance equals $12.50 adverse. Total usage variance equals $32.50 adverse. This shows that both the choice of materials and production efficiency affected the result. Next, we have sales mix and quantity variances. These show how selling products in different proportions or volumes affects total profit. Sales mix variance shows the effect of a change in sales proportions. Sales quantity variance shows the effect of a change in total units sold. Together they form the sales volume variance. The formulas are: sales mix equals actual mix minus budgeted mix times total actual units times standard margin. Sales quantity equals actual total units minus budgeted total units times weighted average margin. Here is an example. The budget was 60% product A at $10 and 40% product B at $8. Actual sales were 70% A and 30% B, with 1,000 units sold. Sales mix variance equals $100 adverse. Sales quantity variance equals $92 favorable. This means total sales volume increased, but the mix shifted towards a lower margin product. Next, we look at fixed overhead variances under marginal and absorption costing. Under marginal costing, we only analyze the expenditure variance. Under absorption costing, we also analyze the volume variance, which is split into capacity and efficiency variances. This gives a deeper view of how well fixed resources were used. The formulas are: fixed overhead expenditure equals actual fixed overhead minus budgeted fixed overhead. Volume variance equals standard hours for actual output minus budgeted hours times standard absorption rate. Capacity variance equals actual hours minus budgeted hours times standard rate. Efficiency variance equals standard hours minus actual hours times standard rate. Here is an example. Budgeted hours were 2,000 at $5 per hour, giving $10,000. Actual hours were 2,200. Standard hours for output were 2,100. Actual overhead was $10,400. Expenditure variance equals $400 adverse. Capacity variance equals $1,000 favorable. Efficiency variance equals $500 adverse. Therefore, volume variance equals $500 favorable, and the total variance equals $100 adverse. Now let us consider planning and operational variances. Planning variance compares the original standard with the revised standard and captures uncontrollable external changes such as inflation. Operational variance compares actual results with a revised standard and focuses on performance that management can control. Separating them ensures fair evaluation. The total price variance equals actual price minus original standard times quantity. It can be split into planning variance equals revised standard minus original standard times actual quantity. Operational variance equals actual price minus revised standard times actual quantity. For example, the original standard price is $5, the revised standard price is $6, and the actual price is $6.30. For 1,000 units, the planning variance equals $1,000 adverse, the operational variance equals $300 adverse, and the total equals $1,300 adverse. Next, let us look at idle time and waste. Idle time represents hours paid but not worked, often due to machine breakdowns. This is shown separately in labor variances. Material waste refers to using more input than planned and is included in the yield variance. Both highlight process inefficiencies. To control these issues, improve scheduling, reduce downtime, maintain equipment, and set realistic standards that allow for normal levels of waste. Variances should be investigated when they are large, unusual, strategically important, controllable by the responsible manager, or when the benefit of investigation exceeds its cost. In modern manufacturing, automation has reduced the relevance of labor variances. The focus now is on machine efficiency, downtime, and quality. Variance analysis must evolve to include these modern measures using real-time performance tracking and continuous improvement systems. There are 4 main types of standards. Ideal standards assume perfect conditions but can demotivate staff. Attainable standards are realistic and encourage performance. Basic standards are long-term benchmarks useful for trend analysis. Current standards reflect today's conditions and are updated frequently. When setting standards, top-down methods are fast but may cause resistance, while bottom-up methods improve accuracy and engagement. The best approach is participative standard setting, combining both accuracy and motivation. To reconcile variances to actual profit, start with budgeted profit, add sales price and sales volume variances, then subtract material, labor, and overhead variances. The result is actual profit, fully explained through variance analysis. To recap, sales volume variance splits into mix and quantity. Material usage variance splits into mix and yield. Fixed overhead volume variance splits into capacity and efficiency. Planning and operational variances separate controllable from uncontrollable factors. Together, they provide a full performance analysis framework. In conclusion, variance analysis is not just about identifying differences, it is about understanding causes and improving performance. Use mix and yield to find inefficiencies, split planning and operational results for fairness, and always set realistic attainable standards. Variances are tools for learning, not for blame. Thank you for watching, and don't forget to subscribe to ACCA Wiz for more lessons on performance management and exam success.